Hello and welcome back to the Freight Flow Advisor Brief, where we break down what's actually moving the freight market so you can make better decisions in your network and your portfolio. Today's episode is about a turning point in freight. J.B. Hunt just reported Q2 2026 earnings, and the numbers and the call are the clear signal yet that the freight upcycle is no longer a theory. At the surface level, revenue is up 19%. Operating income is up 32% and EPS is up 45%. Intermodal volumes in the East are up 31% on a 2-year stack. And now it's also important to note that the dedicated pipeline is at record levels, even above COVID peaks. So if you run assets, buy freight, or manage routing guides, this quarter should matter to you. And it's not because it's a good print. It's really because it explains how the next 12 to 18 months are likely to unfold. So let's unpack what happened. Diving in, J.B. Hunt reported total revenue of $3.5 billion for Q2. That's up 19% year over year. Now, operating income is up $259.5 million or 32%. Diluted EPS of $1.91. And that's up 45% from $1.31 a year ago. So the top line is growing, but the key is that the margins are expanding at the same time. Operating margin moved from 6.7% to 7.4%. And that really tells you this is not just inflation or fuel. This is operating leverage. If you were to look at it by segment, intermodal revenue was up $1.75 billion or 22%. Operating income jumped 58%. Volumes were up 10%, and they set a quarterly volume record of over 578,000 loads. Now, as we pivot to dedicated, it produced $921 million in revenue, up 9%, with operating income also up 9% and retention around 96%. Brokerage ICS grew revenue by 49%, and it returned to profitability. But it saw gross margins compress from 12.5% down from 15.5% because purchase transportation costs surged at least 54%. Final mile shrank 6% on revenue and 30% on operating income as they deliberately walked away from lower quality business. Truckload grew revenue 35%, but swung to a small operating loss because third-party capacity costs spiked. When we look at the balance sheet side, debt is down to about $1.15 billion, and that's from $1.72 billion a year ago. So net CapEx is way lower than last year, and they bought back roughly 392,000 shares in the quarter. So we've gotten through the entire scorecard, but the call itself is where the story really kind of clicked into place. Shelley Simpson, the CEO, summed up the last 4 years in one line. We didn't spend the last 4 years waiting for the cycle to turn. We spent the last 4 years preparing for it. If you only remember one concept from this episode, make it this. This upcycle is supply driven, not so much demand driven. Shelley called out a specific inflection point, and that's the annual road check enforcement blitz, which happened in early May. If you're unfamiliar, that's a 72-hour period where inspectors hammer the industry on safety and compliance. It's important to know that this year, the road check didn't just create a 3-day hiccup. J.B. Hunt saw what Shelley called a noticeable step change in tightness, and that has persisted through this quarter. Capacity came out and did not ever come back. At the same time, Spencer Frazier, who runs the sales and marketing side, described what they're seeing in the data, and that's higher tender rejections, higher spot prices, lower driver employment, all moving back to levels that we last saw in 2021. So if you're new to this, here's what this means. When we talk about tender rejections going up, it means contracted carriers are saying no more often to loads in the routing guide. Ultimately, they can get better rates somewhere else. When we say spot prices are going up, it means buying last minute capacity is getting more expensive. And when we talk about driver employment ticking down, while demand is stable or slowly rising, we really mean fewer people are available to move the same or more freight. And all of that is happening before we've seen a true demand surge. J.B. Hunt said demand improved modestly from Q1, with industrial volumes improving and the U.S. consumer still resilient. So this doesn't correlate to the 2021 style demand shock. This is capacity shrinking faster than demand. Let's pivot to intermodal, because that's the center of gravity in this story. Intermodal, which is containers moving on rail with trucks doing drayage at each end, is where J.B. Hunt is really flexing leverage in Q2. Intermodal volumes were up 10%. The Eastern Network volume was up 16%, and 16% came on top of 15% growth last year. So that's 31% on a 2-year stack in the East. Darren Field, who runs Intermodal, said very clearly, conversion from highway to rail in the East is at levels they haven't seen in more than a decade. So let's talk about why. Well, rising truckload rates, higher fuel prices, and tightening truckload capacity. Think of it like this. When over the road gets more expensive and less reliable, shippers look for a mode that gives them predictable capacity and a cost break. That's intermodal. Now, here's the nuance that matters for pricing. Historically, intermodal contract rates in the East have sat about 10 to 15% below truckload. That discount is what makes conversion attractive. But because most of the 2026 bid season was priced before tightness really showed up, the gap between current truckload rates and existing intermodal contracts is now much wider than normal. Darren basically said that the gap is going to close and the real action is in the 2027 bid season. The first half of 2026 bids didn't see this environment. The back half and the 2027 cycle will. If you're an operator, this is exactly where you want to be. Cost to serve already driven down. J.B. Hunt has taken more than $135 million in structural cost out over the past year alone. And the pricing tailwind hasn't fully hit yet. The only real constraint that they're talking about is drayage. Driver availability in key dray markets is tight right now. They're using sign-on bonuses and targeted wage hikes. They've got the container capacity to grow. The gating factor is people to pull those boxes. Let's take a pause right here because I want to talk to you about FreightFA.com and specifically Freight Flow Advisor. It's a chat-based tool that sits on top of your freight data and live market intelligence. You've been listening so far and thinking, what does a 19% revenue increase and a 10% intermodal volume growth actually mean for my lanes? And how do I translate road check tightening and record mini bids into specific rate assumptions for my budget in 2027? That's exactly what Freight Flow Advisor was built for. You can drop in a lane, say Chicago to Atlanta, and ask rate range given where truckload and intermodal are right now. Freight Flow Advisor will give you AI-powered pricing guidance grounded in current market dynamics. You can ask, where am I overpaying relative to the market? And it will highlight lanes where your contracted rates are out of line. My point is simple. The market is moving fast. If you're trying to manage this with static spreadsheets and last year's RFP data, you're flying blind. So after this episode, check out FreightFA.com and take a look at our Freight Flow Advisor chat. It's built to help executives, operators, and procurement teams make cleaner, faster decisions in exactly the environment we're talking about today. Okay, let's jump back into J.B. Hunt earnings because I want to talk about the dedicated brokerage and the Montgomery effect. Dedicated isn't the loudest part of the J.B. Hunt story this quarter, but it might be the most important signal for shippers. DCS, or Dedicated Contract Services, grew revenue by 9%. They grew operating income 9% and held customer retention around 96%. That's steady, but the real headline from Brad Hicks, who runs the DCS segment, was this: the dedicated sales pipeline is at a record level in terms of trucks, higher than COVID. So why does this matter? Well, it's because dedicated is what shippers turn to when they decided that managing their own capacity is more expensive than outsourcing it. With driver wages rising, enforcement tightening, and rulings like the Montgomery case, which raises the stakes on carrier selection, more companies are saying, we don't want to own all the risks. We want a partner with scale, safety, and predictable service. Nick Hobbs talked about Montgomery directly. The ruling increases broker liability for carrier selection. J.B. Hunt already runs above federal minimums and uses dynamic monitoring, so they don't see additional risk. But they are seeing more carriers move to their platform, and Hicks sees Montgomery as one of the reasons shippers are leaning toward dedicated solutions. Remember, dedicated is a slow burn growth. Hicks reminded everyone during the call that the sales cycle is 12 to 18 months. Fleet growth comes first, then margin improvement. That means what's being signed in 26 will show up in late 27 and 2028. Now, brokerage ICS grew 49%, but it did it with gross margin compression from 15.5% down to 12.5% because purchase transportation costs shot up. That's the classic brokerage squeeze that we talked about a few weeks ago. Your customer rates were set when the market was loose. Your carrier costs are being set in a tight spot market. Hobbs put it bluntly, quote, pricing implemented just a few months ago is no longer sufficient. ICS is using mini bids and spot opportunities to reprice closer to current conditions. And margins improve sequentially from Q1. But the takeaway for anyone in brokerage is this. You can't run a 2024 cost structure in this 2026 market. If you don't have the tech, density, and discipline to reprice your entire book and control your purchase transport, this phase of the cycle will expose you fast. Everything we've talked about so far is domestic, but if you sit on a global supply chain, procurement, or trade, this quarter matters just as much to you. You may ask why. It's because domestic capacity is the last mile of your global network. So here's the link. Tight domestic truck and drayage capacity means containers stay longer at the port. And what that does is it raises dwell times and it puts pressure on chassis pools and it pushes more freight onto rail ramps. Ocean carriers and BCOs who thought they had plenty of time to clear boxes will find themselves paying more for inland moves, even if ocean spot rates stay flat. On the call, Spencer Frazier said customers were not positioned for the speed and magnitude of the shifts. That's also true in domestic and global flows. They're already helping customers plan for fall peak and even transportation planning in 2027. The thing to remember about global supply chains is they always break at the weakest link. Right now, the weakest link are driver availability, drayage capacity, and underpriced domestic contracts. So as we wrap up this episode, I have a few takes here. If you're a carrier or asset operator, you need to be documenting your cost inflation. Driver wages, insurance, fuel, equipment, make sure you have that data ready because the pricing window is open, but the carriers who show their math will move faster in contract negotiations. If you're a shipper, you need to start expecting more out-of-cycle bids. Frazier said mini bids are becoming structurally larger as customers compete for capacity and reset networks. So to wrap this up, J.B. Hunt's Q2 2026 earnings story is this. It's not just about the beat and the raise. It's a confirmation that the freight cycle has shifted into a supply-driven upcycle. The companies who spent the downturn fixing cost, building capacity, and investing in their people are now compounding those decisions. Now, if you want to go deeper on this and how it translates to you, check out our Substack, the Freight FA Brief, and use tools like the Freight Flow Advisor that can help you turn this macro story into lane-level decisions. If you like the show, make sure you share it with a colleague. You can follow us online at social media platforms at the Freight Flow Advisor on LinkedIn, Instagram, and Facebook. You can watch us on YouTube, or you can listen to this podcast on Apple and Spotify. Until next time, this has been your Freight Flow Advisor Brief.